There's a market that's worth over $100 trillion that impacts your mortgage, your job prospects, your 401k balance, and even Bitcoin. This market is silently influencing your everyday life, yet most people have no idea how it works. It's not stocks, it's not crypto, it's bonds. Bonds are the backbone of the global financial system. And having a better understanding of how bonds work can help you make better investment decisions, avoid getting crushed by inflation, and even time your next big purchase. Let's get into it. At its core, a bond is just a loan. You lend money to a borrower, and the borrower promises to pay you back with interest. And that interest is to compensate you for the risk you're taking and the time that your money is tied up. The government borrows money to try and invest in the long-term productivity of the country. This could be infrastructure spending, defense spending, healthcare, and the government wants to cover as much of that spending as possible with taxes, mostly payroll taxes and individual taxes. But every year, there's a shortfall between what they collect in taxes and what they actually end up spending. This is what a budget deficit is. The deficit is annual, and the national debt is the sum of all those past annual deficits. So the US Treasury tries to cover the annual deficits by issuing bonds. They'll sell these bonds at auction to banks, pension funds, foreign governments, and even regular investors. US Treasuries are seen as one of the safest investments in the world because the government can always just raise taxes or print more money to pay you back. And that trust is what makes this whole bond system work. So let's define a few terms around bonds. So the principal is the amount that you loan or invest into the bond. And then the coupon is actually the fixed interest rate payment on the bond. And then the maturity date is the date that you're going to be fully repaid on the bond. And then the yield is actually the return that you're receiving on the bond. So a lot of people get confused between the coupon and the yield, and they'll use these two terms interchangeably, but you can't interchange them because that yield will actually change based on the value of the bond. So these bonds actually get bought and sold on a secondary market. So that initial price that you pay can change. Let's do an example here. So say you bought a bond for $100 and it had a 5% coupon. So that's $5. That coupon is never going to change. But then a year later, the Fed decides to raise rates and the new rate is 6%. So your $100 bond at that 5% coupon is less attractive. So the bond price is actually going to drop from $100 down to about $80 to make your yield match market rates. So now you have $5 on this $80 bond and your yield is about 6.3%. The coupon never changed, but your actual yield from the bond did. The bond price and the yield actually go in opposite directions. So if the price is going up on your bonds, your yield is going down. And if the price on your bonds is going down, the yield on your bonds is going up. Interest rates are set at US Treasury auctions, and the investors at these auctions decide what rate they're willing to accept to buy these bonds. But these investors are looking at inflation data and GDP growth and Fed policy. They're trying to figure out the health and the future of the US economy. And if they think there's going to be rate hikes or recessions or higher inflation data, they want a higher yield on their bonds. So bond yields are a window into the health of the overall economy. But here's the problem. Those higher bond yields mean that the government's borrowing costs are also higher. And the US debt is sitting at just over $34 trillion. And it's regularly rolling over that debt into bonds with shorter maturity timeframes. And those higher interest rates mean higher payments. And that money has to come from somewhere. So the government either has to raise taxes or it has to cut government programs to cover those higher payments. So these rates really do impact your day-to-day life. The government refinanced a lot of debt at lower rates during COVID, but that is expiring. Now, those old debt payments are getting rolled over into high interest rates, which means rising costs to just keep the debt afloat. And eventually, those higher payments could crowd out spending on things like Social Security, education, defense. It is a big deal for the US government's budget. But how does all this impact you? Government bonds are viewed as being essentially risk-free. So imagine you could get a 5% return from bonds and only a 7% return from the stock market. That's only a 2% difference in returns. It starts to look very attractive to just park your money risk-free in bonds instead of taking the risk in the stock market. This is called the equity risk premium. That 2% difference is your reward for risking your money in the stock market. And if that equity risk premium starts to approach zero, it throws everything out of whack. Pension funds, retirement funds will start pulling their money out of the stock market and investing in bonds. This will cause stock prices to go down and your 401k balance to go down. One other interesting thing about bonds is that they can predict recessions. So usually the long-term bonds have higher yields than the short-term bonds. And that's because your money's invested for longer and you want to be compensated for that additional time and additional risk. But sometimes the short-term bonds have a higher yield than the long-term bonds. This is called an inverted yield curve. And usually the two curves investors like to look at are the 10-year treasury versus the 2-year treasury, or the 10-year treasury versus the 3-month treasury. But when these curves invert, they've actually predicted every recession in the United States since the 1950s. It's not instantaneously, but it does happen consistently. So now that you understand how the bond market works, how do you actually apply it to your finances? So we already established that as these yields start to rise, things get more expensive for the government. So you can kind of prepare mentally for financial policies from the government that aren't beneficial to you. They might start cutting potential benefits, or they might start raising your taxes just to offset the higher cost of borrowing that the government is going under. The next thing you can do is actually time large purchases. So if you know rates are going to continue to rise, then now is probably the best time to buy. But if you expect rates to continue to drop, then you know you can delay a bit and potentially get a better interest rate. And then there's a website that I like to watch, the Federal Reserve Economic Data website, FRED. So this is where you can actually look at that long-term and short-term yield curve. And if they invert, you know that you should be assuming less risk in your investments. You can put hedges into your overall investment strategy to protect yourself against the downside risks that the market is already pricing in. And the last thing that you can do is put your idle cash to work in these treasury bills. So a lot of people try and chase money market accounts and high yield savings accounts, and they're constantly switching between accounts to try and get the best yield. All of these accounts are just going to follow those short-term treasuries. So just buy the short-term treasuries. And I personally don't like to buy them directly because I want more liquidity. So I buy ETFs that track those short-term treasuries. So SGov or BIL, these will give you around 4.5%, which is very close to what you can get with the best money market accounts. And the last thing is actually looking at your equity risk premium. So not everyone is going to be investing super aggressively in high growth tech stocks. So if your equity risk premium is small, like a 2 to 3%, it may not be beneficial to you to have all your money in stock. It might be better to de-risk and put more of your money in bonds. And that conservative investment style isn't ideal for growth, but it is ideal for preserving your capital that you've worked so hard to accumulate. So the bond market isn't just some dusty corner of the finance world. It affects your everyday life. And if today's video gave you a better understanding how tracking the bond market can actually help you make stronger financial decisions, like the video and subscribe to the channel, because I give practical tips like this every single week. And if you're still trying to make heads or tails of the big beautiful bill, I actually did an entire video on the 5 biggest changes to your finances from the big beautiful bill. Keep getting 1% better every day, and I'll catch you in the next video.